Let me go across. We have Shreyas Devalkar, who is head of equity at Axis Mutual Fund, joining us this morning. Shreyas, great having you. Let me first start off by understanding where you sit on with regard to the entire AI and IT saga. You believe that what's your key takeaway from everything that's played out over the last 24 hours or so? Is this a buying opportunity, you reckon?
So it's a really interesting time for most sectors, but more so for IT. If you look at the AI wave and historically also, there has been multiple technological advancement which happened in the sector. At least when you look at from the sector company perspective, their perspective is always about whenever there is some technology change. Normally, such big tech wave gives opportunity to companies. It accelerates modernization of legacy system in large corporates, and that's where there is a significant deployment gap, which is there and which provides some opportunity to these companies. But with AI, the difference is that yes, it may also be deflationary in a sense. Various experts on this count talk about right from 3 to 5% deflationary. And that's where you will notice that the expectation from the sector growth perspective is in mid-single digit, or even in some cases, even in the low single digit, so low to mid-single digit kind of. So broadly, in my opinion, when it comes to the earning growth in near term, market is assuming there is an impact. The question is always about the terminal growth for this, and the stocks have definitely got derated. From Indian perspective, if you look at the metric like dividend yield or free cash flow yield, on this metric, definitely stock look reasonable from the valuation point of view. However, in the IT sector, I always try to compare the multiples not only in the Indian context, but how their foreign peer are trading at what multiple. So in that context, our companies are broadly, one cannot call them as a real value per se when you compare it to the global companies. So all in all, after this correction, in my opinion, from a relative valuation from the Indian peer set or competing sectors are concerned, then the valuation look reasonable on especially the yield front.
Right. Okay, Shreyas, hi, morning. So, given the way earnings have shaped up to be, given the way the valuations are in the market right now, amid this existing setup, what is looking good? Where are you overweight and where are you being cautious in the market?
So what has changed if you look at from last 6 months or so? One, the delta came in the auto sector, which is known and mostly it got priced in also early on. Their only concern now, in my opinion, is about commodity cost increase and ability of sector to pass on. The most important point is commodity cost increase is given. How you can pass on based on the model life cycle, that will differentiate a winner from loser in the auto sector. We are positive on this sector, especially the CV cycle, which has shown improved sign of uptick in last 2 to 3 months. Tractors are doing well, so then generally broadly this sector looks okay, and that's where as of last month, and you would observe that we are positive on this. In again last 4 to 5 months, there is a delta which is being observed in the credit growth front, and this credit growth is improving across segment, and that was observed in this result season as well. Particularly, it was observed especially in the corporate loan and overall banking. In the Q3's result also, we have seen that it has seen bottoming out of the NPA cycle, and that's where this sector is where we are positive on, and that's where again in last 3 to 6 months this sector saw a lot of flows per se. Apart from these two sectors I would call as reasonably priced. But other sectors which are doing well, and they are not necessarily reasonably priced, but they are doing well, which is definitely the capex sector, capex and manufacturing, in which we have seen that the volume growth coming and order flows continue to do well. So in the cement, steel, cable, wire, these are the sectors which have done well, especially in case of capital goods. It is the power sector, capex, electrification. This part has definitely done well. However, many opportunities in this segment continue to remain expensive. But this theme being broadly long term, not only in India but worldwide, the electrification, I think even this sector has a good weightage in our multiple funds.
Right. Shreyas, what is it that you would absolutely avoid at this point where maybe you're seeing an earnings downtake and therefore valuation comfort not available, or where the risks look elevated at this point?
Uh, in this conundrum of earning down critic versus valuation, generally in India, in last few years per se, what I would call out is the broader consumption segment is where there is a concern. So if you take FMCG sector, so there is the growth versus the valuation is a concern, and that's where we have been underweight on that segment. One need to watch out for the newer segment as well in this. So it is a modern retail or it is a quick commerce. It's not about concern per se, but yes, valuations are high, and that's where the incremental delta market will closely watch out for in this segment. And that's where these are. But however, one need to be very choosy, and that's where we are also positive on some of the companies in this segment. But it so we have to be very choosy in this sector broadly, in my opinion.
Okay. Shreyas, very quickly, with regard to banking and financials, at least the larger banks haven't done much over the last 12 months or so. Competitive nature in banking has gone up. Where do you sit on PSU banks with where there is better value in your basis your opinion, or do you still stick to the private lenders where valuations have come up from the highs?
So your observation is right, and if you just even step back even further, and then if you see pre-COVID versus now, because in multiple sectors we tend to do that what is the pre-COVID multiple versus now, and what is the change in growth rate, then private sector bank as a pack is has got derated during this time, and the concerns are well known in this segment, right from ROEs to slower growth to deposit issues, etc., etc. But fact of the matter is, yes, this has got derated because of the multiple reasons. The reasons which I highlighted, that yes, there is an improvement in credit growth, which is seen even in the last fortnight. Even the deposit growth has seen some uptick as such. So if this and this is, in my opinion, is outcome of monetary policy and easy liquidity, which RBI has started giving since 1 year ago or 1.5 years ago now, and that has actually resulted in a good outcome for the sector, and the NPA cycle also is good. So I would call out one. So the question is on the private sector bank. Yes, they themselves has got derated compared to their pre-COVID, so that makes them relatively attractive. And PSU bank definitely has improved on their performance during this time period. If you look at their growth, their market share gain in various categories, their turnaround time, and in that sense, we have many of them in our multiple portfolios as such.
Okay, Shreyas, thanks so much for your views, and thank you so much for joining us this morning with your time. Thanks once again.
Sure, thank you.